The greatest speculative bubble of all time in all things, according to hedge fund manager Michael Burry of Big Short fame, burst last summer. He alerted the individual investors flooding the markets with meme stocks and cryptocurrencies that they were headed for the mother of all crashes. The S&P 500 and Nasdaq indexes have fallen 15% and 24% respectively, which suggests that the Scion Asset Management chief's gloomy prognosis may be coming to pass. Burry claimed credit for predicting the sell-off in tweets that he has since removed. He also detailed why he anticipates future drops and warned against investing in relief rallies. Stocks will tumble, says Big Short investor Michael Burry, and rallies won't last. Is Michael Burry's mother of all crashes over? Let's find out. I'm not short. Michael Burry warned us last year that he thought the stock market was about to see the mother of all crashes, and a little while after, it started to fall apart. The S&P 500 is currently down 15% from its high, and the man who gained notoriety for betting against the housing market in 2008 just before it crashed tweeted, "I'm not short." Furthermore, this is significant news for Michael Burry because as late as last year, he had short positions in which he bet against both the market as a whole and specific companies. Michael Burry is someone you should pay attention to since he offers original economic insights and assists regular investors in grasping the internal dynamics of the economy. While he does make a lot of forecasts, many of them are inaccurate and are just overlooked. He's been talking nonstop recently on numerous topics. Instead of trying to time the market or actually making any financial decisions, we should just be analyzing what is happening to better understand how the market works, according to Burry's predictions. "I'm not short," writes Burry's most recent tweet. And while this is rather straightforward, we believe there's a lot we can learn from it. In the world of finance, shorting something or going short fundamentally implies placing a bet against how well a stock or other security will do. In essence, it's the reverse of buying a stock long, which simply entails buying it with the intention of selling it for more money than you paid for it if the stock's price rises. You sell the stock initially when you go short. You can then buy it again at a lesser price if the price drops, effectively profiting from the falling stock price. If you own one of these options and the share price falls, you can use the contract to buy the stock at a lower price and then sell it at a higher fixed price. Burry made use of these contracts sometime throughout the year 2021. The most prominent instance was the purchase of 20,000 put option contracts on U.S. Treasury bonds with a 20-year maturity. Burry was essentially wagering that as inflation worsened, the Federal Reserve would have to raise interest rates, which would then lead to a decrease in bond prices. 13F SEC filing. Michael Burry placed this wager in the middle of 2021. He was largely correct in terms of what transpired and the procedures that were put in place. Burry no longer has any put option contract bets as of the most recent 13F SEC filing, which lists his U.S. stock holdings. Additionally, it's reasonable to believe that he no longer holds any direct short positions given his most recent tweet, which stated, "I'm not short." In light of this, does it imply that the mother of all crashes is over? The market will only increase from here? Well, not necessarily. Last year's market decline hasn't even come close to the massive speculative bubble that Burry has been warning about. Although the ratio of stock prices to earnings has improved dramatically this year, it's still roughly 33% higher than the long-term average. Therefore, you may assume that the stock market will continue to decrease even more in the future if interest rates climb and eventually reach their long-term average and the earnings of the S&P 500 remain flat or even decline. We shouldn't interpret Burry's tweet as indicating that the stock market crash or recession is over. Rather, we believe it just indicates that he's no longer placing a broad bet on the economy's future direction. His most recent 13F filing made a number of new stock investments public, which he covered in a number of adjustments. Burry's portfolio. Burry had just one U.S. equity at the end of the previous quarter. He now has 6. He launched investments in Curate Retail, Core Civic, Aerojet, Charter Communications, and Liberty Latin America, in addition to increasing his wager on Geo Group by 300%. Despite the fact that they represent relatively smaller wagers than some of his other investments, he also marginally lowered his interest in 3 Japanese companies. It's difficult for us to understand the rationale behind some of the bets because the stocks in Burry's portfolio are all extremely distinct from one another. However, prior to the public release of the 13F filing, Burry attributed at least some of these bets to his thinking. He claimed that low-price cash flow businesses are different today versus 2000 because they will buy back stock, buy back debt at a discount, and in general manage capital structure better, make them statistical values, math problems that more or less must work out. He continued by saying companies that are heavily leveraged but have the cash flow and termed out debt have options today, including reducing their debt loads at a significant discount brought on by higher rates. But as Graham said, in such a case, better off buying the stock. The worst situation currently exists for businesses with extremely low cash flows and large debt levels, since rising interest rates simply mean that these organizations, which are already cash-strapped, will continue to experience an increase in the cost of their debt. Higher interest rates, however, essentially only give those businesses a chance to repay their debt at a discount if they have high debt levels and strong cash flow. A corporation can effectively just utilize its cash flow to repurchase those bonds at a discount, as the price of older bonds with lower interest rates would decrease as interest rates rise. In addition, as interest rates rise, stock values typically decline, just like when a firm buys back its own stock. Additionally, if a company generates a lot of cash flow, it can utilize it to repurchase its stock at a discount. Burry adopts Benjamin Graham's reasoning that even in these situations, it's beneficial for the corporation to repurchase its own stock. Repurchasing debt or stock at a discount increases value for shareholders. Qurate Retail Group is one stock in the portfolio of breweries that appears to fulfill this criterion. Utilizing live television shopping shows, Qurate Retail offers consumer goods. The business's revenue, operating income, and free cash flow are all quite consistent. Additionally, it trades at just 10 times free cash flow for the upcoming year and has a debt of around $7 billion. Moreover, the corporation was fundamentally repurchasing its own stock with all of its free cash flow up until the year 2018. However, this practice has decreased in recent years as earnings have declined. In light of his tweets at the end of the quarter and this bet, it appears that he's identified a relatively stable firm that has a track of making aggressive asset purchases and that is trading at a relatively low price to its free cash flow. These kinds of bets are very usual for Michael Burry, and they fundamentally follow the principles of Benjamin Graham's classic value investing, which was established about a century ago. These are strong investing ideas that have helped numerous investors in the past and present produce sizable returns on their holdings. Value investing. One can learn more toward the recent value investing ideas put forward by people like Warren Buffett and Charlie Munger, which means you're concentrating more on high-quality firms than merely investing in companies because they're inexpensive. Nevertheless, Burry's portfolio contains something more intriguing than just these particular businesses. Only roughly $70 million of the over $300 million assets under management belong to the US and Japanese stocks shown in the ticker. Thus, we're essentially unaware of the great bulk of Burry's portfolio. It's possible that he has cash. However, it's more possible that he has numerous bets in foreign markets where we are unable to view the SEC filings, where he does not hold a sufficient amount of the firm for it to be reported by the company, or, of course, it might indicate that he has short positions. However, considering his tweet, we believe that's highly unlikely unless he's simply outright lying on Twitter. In the end, though, what makes this important to us is that it serves as a great example of why you shouldn't copy institutional investors. We don't really get the whole picture, not simply because the 13F filings are 45 days late. Additionally, in this instance, we're only receiving a small portion of Burry's whole portfolio. This is especially true with something like Michael Burry's portfolio, where he's placing a lot of small bets in the US and internationally, the majority of which are likely to fail. For the portfolio as a whole to perform well, only a handful of these need to perform exceptionally well. Therefore, if you simply imitate one or two of Michael Burry's bets, you'll probably lose. In addition to his stock interests, Burry has resumed discussing the economy in his tweets. He tweeted 156 years ago there was a market panic in England that led to the creation of the first modern-style central bank, paving the way for the Fed and for our absolute dependence on every ducking word of its chairman. It has always been about plunge protection. Burry is merely highlighting one of the main drawbacks of our existing financial system, which includes a central bank that has the power to quickly and drastically affect the markets. Whatever the Fed's drone authority says, the market frequently reacts to it right away. Powell has said that lower interest rate increases will likely be required in the future. The Nasdaq increased by 4.4% in a single day as a result of the announcement, with shares of Tesla and Netflix rising by 8% each. And it's completely illogical that such a minor remark by the Fed would immediately have such a huge effect on the markets. It is true that future interest rates will affect how equities are priced, but it's absurd to believe that Jerome Powell is aware of these rates. The interest rates of the future remain unknown. Jerome Powell, for example, continued to believe that inflation was temporary even 12 months ago. Interest rates are currently 3 times higher than they anticipated 12 months ago. So why should their predictions for interest rates or inflation over the following 12 months have any bearing on our investment decision if they were so inaccurate over the previous 12 months? But we've reached the end of today's video. If you want to learn more about what Michael Burry says, you'll probably want to check out this video too. Cheers.